Welcome back again to this week's Weekly Wave. This week we're talking about financing the deal. This is step 10 in the 14-step acquisition process we've been going over the last few weeks. So if you're thinking about investing with us or any other sponsorship team, financing is actually one of the best parts of the deal because as a passive investor, you don't have to worry about doing anything to do with the loan. The sponsors put their net worth, their liquidity, they set up all the loan docs. They're the ones that sign on, the risk for the loan. And the passive investors or investment partners that are limited partners in the deal, you're simply just on the LLC docs as a silent partner. So today we're going to pull back the curtains a little bit, show you guys a little bit of behind the scenes look at how this actually works. If you guys are wondering, how do these guys get these loans? What do they got to do to get these? Or if I'd like to learn a little bit more about getting one myself. I brought in my friend Chaim Sherwinter from Meridian Capital, so we're gonna hop over there to that. I just spoke with him, and you guys are gonna love it. He shares with you everything about Fannie Mae, Freddie Mac, multifamily, agency financing, and how we can get some good terms right now in these markets. He even drops 3 bonus hot tips about good MSAs to invest in right now. So you're not gonna want to miss this one. All right. Hey, well, thanks for joining us. Just a quick look behind the scenes. I want to introduce you to one of our capital partners here. This is Chaim Sherwinter. Chaim's the vice president of Meridian Capital Group, who are the premier commercial brokerage in the country. And Chaim has a tremendous amount of experience closing deals all across the entire nation, all markets, and all asset classes. So, Chaim, can you tell us a little bit more about yourself and your background in the commercial real estate industry?
Yeah, for sure. Well, thank you, Benjamin, for having me on. It's a great pleasure. I actually, just a little background on myself. I actually started here in Meridian a few years ago. And I was originally going, a bunch of years ago, I started off going for pre-med, as my father is the chief of surgery here in New York, a large New York hospital. And I was working on it, doing it. I was actually doing great, but after a little bit of time, I realized that it's going to take me about 7 years to actually start making some money here. So I decided, what, screw the whole 10-year wait, and let's get into real estate. Let's start see how it works out. And thank God it's been amazing, and I've been flying since I started. Thank God.
Amazing. Thank you, God, for sure. Well, so we want to kind of, as we're bringing everybody behind the scenes, and pulling back the veil a little bit about how things go when we're looking at deals together. Can you tell us, and just kind of start off, basically, people hear everyone talking about getting agency debt or all these different types of products. Can you just kind of basically just give us a little bit of an overview for everyone to understand what is multifamily agency debt and why that's a popular choice for multifamily investors?
Yeah, so agency debt is really just basically the government has created 2 different programs. One's called Fannie Mae, one's called Freddie Mac. The reason that a lot of people like them is very often, it's based on the treasuries. Very often treasuries go down, and it's very secure way of getting debt, being that it's from the government, as well as very often the interest rates are very favorable, interest only, that they can offer, as opposed to, let's call, banks or credit unions or life insurance companies. They can offer interest only on a basis even up to half or full term interest only. So they're a very good option, and especially if I'm sure we'll talk about this more later, but especially if you're an experienced borrower, even not specifically to the agencies, it can definitely it's once you know how to do it, once you get go through the first few times, it becomes very simple. They ask for they do a lot of underwriting, which I'm sure we'll get to as well, but they're once you get to know their system and get to know how they work and how the prepayments work and how the rates work, it really is a very simple and could be very useful lending platform for you, as well as they could generally, now it's a lot harder during this current market, but a few months ago you were actually able to get up to 80% of the loan to value, which again, you can still do it in this market. It's just gonna be a little tougher, being that the market's not exactly as great as it was
Right. Yeah, that's definitely something, obviously we're all looking at as we're underwriting, getting our leverage ratios correct there. So that's always something we're definitely looking at. It is nice compared to some of the other, if we're going a traditional bank or whatnot, being able to get a little bit better leverage on the deal for sure.
Yep.
Now, it is kind of it is like quite a, intricate process getting set up as we go into these deals. Can you walk us through the process, like just so everyone else can understand, like when I pick up the phone and I'm talking to you, I've got this deal. Can you walk us through the process of how we get that deal done and who are the key players involved? Because I know, you're always saying, hey, Ben, who's in this deal, what it takes for people to get these types of deals closed and what type of documentation they need to have to secure this the debt, and walk us through a little bit of the process, documentation, who's involved, and how to get there.
Yeah, for sure. So, we have, the way it works with agencies, obviously they'll look at the deal, they'll look at the market. The underwriting stage is really a later point, but I can tell you that, one of the most important things is to have, you can walk in. If I, decided today that I would start buying real estate, when I started originally, that I actually bought some real estate when, I will try to get an agency loan. I wasn't very knowledgeable. And, they said, let's see your PFS. Let's see your REO. And, I was like, I don't know what that means, but I'll check, I'll look into it. And, I found out what it was. It's just basically the PFS is a document saying what your net worth and liquidity is. And obviously my net worth and liquidity at the time was not extremely aggressive, to say the least. Um, but yeah, I would say that two of the most important things that the agencies look for is going to be, a strong sponsorship in management experience, let's call it, as well as a strong sponsor in net worth and liquidity. Meaning, you can have a guy, that has, $500,000 on a bank going get a $80 million deal, $80 million loan. That's just not going to work. They like to see 10% of the current loan amount in the for bank account post closing, as well as in the liquidity, as well as 1% of the loan amount. Obviously, people would rather more than 1%, 2% of the loan amount in net worth. Again, but that's pre liquidity, pre closing, right? So I'd like to see, you have to have very strong, background. That if even if it's your second deal and you've done it, before, it could be good. You can still get a loan. It's just gonna be more difficult. Obviously, it takes time to build yourself up. It's not built in a day. And but once you get to know their system, once they get to know you, it becomes a lot simpler to get agency loans. But it takes a lot of work to be able to get the PFS to where it needs to be, as well as the REO to where it needs to be, to make them comfortable.
Yeah, fantastic. That's a great answer. Yeah, and that's, for us as well, that's something, as I brought to you, introducing you to who our partners is. And if for folks just starting out in the business, this is a great opportunity for you to get out there and network. You need to be working with experienced sponsors who have a proven track record of taking deals all the way through full cycle and actually performing on those deals. So great answer, Chaim. Thank you. So what other factors do the lenders consider when underwriting these types of loans for the asset? Are there like any deal breakers that people should be aware of, just kind of when they're doing their own initial analysis before coming to you with the deal?
So let's talk about underwriting. I think, which is a very important,
For
probably
sure.
one of the most important aspects, if not the most important aspect of doing a deal, and aside from agency and doing a deal altogether. But specifically by agencies, they have very, specific, let's call it, rules on how they would, underwrite a deal. That obviously one of the most important ones is the debt service. If you have, the property is cash flowing to the amount of money that is needed to, to pay off the loan. So, generally Fannie Mae debt service is going to have to be at a 125 cover. It means you have to have at least 100, 25% over what your debt is, what your annual, monthly and annual mortgage payments will be, in order to be able to pay that off. And for Freddie Mac, depending on the market, in the top markets, it's a 1.20 debt service coverage. And the very small markets, there's obviously a big range, but in the very small markets, it's a 1.4 debt service coverage. Obviously, in the middle, it's 1.25 and 1.30, depending on how small or how standard the market is going to be how they, evaluate what the debt service coverage ratio has to be. Another thing would be obviously, the MSA, like where's the asset located? Some MSAs are, 65% of MSAs. Some MSAs could go up to 80%, as we discussed earlier. You can get, higher leverage. Again, nowadays it's much harder to get the 80%, leverage, but you could technically get that. The median income of the property is being looked at. There's a lot of different factors here to see, how stabilized property is. It 95%? Is it 90% now? It'll be 95% by closing. There's many different points to the underwriting, outlook of the agencies that, but outlook and, underwriting in general, which are very important to understand and know. And again, when you're a first time guy, you might not know as much as, you need to be able to pull that off. And that's why, very often people start off with a guy like Ben or other sort of, groups of guys that have done this before and know what they're doing, and, learn it and get the experience as they're growing with the investments that they make.
Absolutely great. Let's just go ahead and give everybody 3 golden nuggets. I heard you say right there. Let's give us 3, bomb us out 3 top MSAs for that high leverage ratio right now.
I would say, it's a tough question, changes every day, but I would say probably Texas, Florida, Texas, Florida, top MSAs. Texas, Florida, probably.
All right. So you heard it here. Oh, North Carolina, you heard it here. Texas, Florida, North Carolina. So if you're not looking for deals in those markets, you might want to start. So you heard it here from the mouth of the guy that's doing the deals here all across the nation. Okay, so that's multifamily agency loans. What is the difference between a small balance or a large balance loan? Because you see those terms coming out. So can you clarify that for everyone, what they need to know about getting a small balance or a large balance?
For sure. So a small balance loan is generally designed for a loan that would range between about $1.5 million to about $7.5 million.
Okay.
You can get from the agencies. There's a bunch of different options. Obviously, it doesn't have to be only agencies that are offering small balance loans, but generally people go to the agencies with small balance loans. They offer a 5, they could offer a 7, they could even offer a 10-year deal. Actually, in the beginning of February, I believe it was, they were offering a 40 point, many of the lenders were offering a 40 basis point discount on small balance lending. Then I'm not sure if you watched the treasuries over the February, but they jumped up dramatically and the bucket got used up really quickly. So instead of it being 40 basis points down, it went 25 basis points up. So they ended up charging a higher rate, but they started off with a special discount for smaller deals. But larger, at non-SBL loans are going to be, from 7 million and up. They can go up to $1 billion, unlimited amount of money. So again, that the rates, sorry, let's start with the size of the deals. Generally, small balance loans could be between let's say 5 and let's say 50 units area. Let's call it. Large LBL or the non-small balance loans would be more like 50 units and up. Or if you're buying in a really hot market and your deal is $20 million, that can be that will take it out of the SBL loan as well.
Sure. So you could have a large balance loan on a 20-unit A-class deal in a top-tier market, essentially.
Yeah, essentially. That's
right.
not. Generally, it's not. Generally it's not the way it doesn't underwrite like that. But definitely, if you could buy a 5-unit property on Fifth Avenue in New York City, I'm sure it'll cost you a lot more than $7 million. So
that's right.
Yeah,
we'll come over to your house later and hang out.
You're welcome
when you move in there.
And
so just to kind of since you guys are working behind the scenes, and you've got your ear to the ground with all things happening, I'm hearing 3 more raises this year by the Fed. It's going to level out. Maybe you could shed a little bit of light kind of behind the scenes, what you guys are hearing internally and some of the talk that you could share with us to kind of paint your just generalization of the marketplace right now and kind of what that's looking like for everybody.
For sure. So Ben, I'll be honest. If I knew what was going to happen in a month or 5 months or 10 months, if I knew that factually something was going to happen, I would be a very rich man because I would be giving advice to every single big company. But no one knows. It changes every month. The rates change every month. The Feds decide. One day they have money. The government has money. One day there's no money. One day we're in a session. One day we're not. No one knows the facts. Which again is another reason where I'm a strong believer in the new guys that are starting off that are going to be jumping into this. They today the rates are 6.5. Tomorrow they could be 7.5. And if you underwrite it to a 6.5, rate deal, and then tomorrow it's 7.5, then you're stuck. That's really another reason why I'm a very strong believer in going with the a strong team. Really, even obviously, again, I'm happy. I'm gonna work whether it's you're a single guy or you're coming from a company such as yours, but I believe that with a market the way it is, as volatile as it is, you really need to know what you're doing in order to really pull off deals nowadays. The if you're going to start off in a market like this that's tough, I can't tell you what's going to happen in a month. I can't. I've been doing this for a pretty decent amount of time, but I don't think guys been doing this for 30 years or 40 years can tell you what's going to happen in a month. This is unprecedented, market volatility, and no one can tell you what's going to happen. So
Absolutely. And that's a great point. And just kind of one thing we do to mitigate that on our end, when we're underwriting, we actually start underwriting like 10 BPS points per year as the deal progresses of going up. So we project in our underwriting that we're going to exit the deal in a much worse economy, and we're projecting that we're going to have to refinance this in more of like an 08 to 12 scenario rather than an 18 to 2018 to 2019 scenario. So we project that everything's going to get worse. And so when we project our refi after our renovation, we're saying like, hey, we're probably like, let's look at 8, 10, 12%. What does that look like if we have to refi in that type of lending environment? And if the deal still works, we know we've got a winner here, and that's one we're going to take to our investors.
yeah, that's for sure a great point. And again, the agencies is one of the things in underwriting that I didn't mention, but the agencies will also, as well as any lender, really, they have a stress test that they've got to run. And first time guys, I didn't know this when I first started. I just figured, oh, it's 6.5 rate today. Let's do this deal. It makes sense today. But then I took some of the deals to the lenders, and they looked at it. They're like, yeah, we stress it at an 8% deal, going at a 8 debt yield. The deal just didn't work at all. And obviously I didn't get a loan for it. But again, that coming in as a new person, it's great, and real estate's a great thing to join. But you really got to know where you're coming from, know what you're doing to be able to make the right decisions and make money as opposed to lose it.
As well as have great partners like you to have be able to lend an ear and bounce ideas off of. So that's one thing I really appreciate about Chaim and Meridian Capital. From day one when I met Chaim, he said, Ben, you need to know something, call me. You want to shoot a deal my way, we'll look at it for you, we'll turn it around same day. So besides the being very responsive and having that sense of urgency, please tell everybody why Meridian Capital is a great option for them for their financing their next acquisition, and maybe shed a little light on kind of maybe one of your successful projects recently and what you guys are doing over there and how you can benefit everyone else.
Yeah, so I would definitely love to talk about one of my successful projects recently, but I'd rather talk about something that was last week. This past Friday, actually, rates dropped, and we had, being a company the size of ours, a pretty large firm, we did $57 billion worth of debt financing last year, which is, I believe the most debt without actually lending out any of our own money in the country. And last week the rates dropped by I think 30 basis points on Friday morning, and I believe we locked deals at about 5.30 rate, 5.3% rates with the agencies, and that's again with rates a month and a half ago were at six plus or 6.5, even 2 weeks ago 6.5%, and that we were able to lock deals just because of the knowledge that the firm and the brokers that we have, they knew that they have to have their people ready, locked and loaded. So the second that rate dropped, we pulled the trigger, and a lot of our clients saved a lot of money on that. I would say the reason that Meridian is so well sought after is because we, as I said, we do a lot of deals. I believe last year we did about 4,000 deals, commercial loan, and we have a great team, great processes. Ben, as I told you, we're always ready to look at a deal. It doesn't matter the size, location. We've done deals wherever it's been. We've done a deal there, and we know we have access to the market. We have access to the people we need to look into the deal, look into the market, whether it's appraisers, whether it's people in the tax, to find out about taxes. We have those people that we can call to ask information, as well as in the firm itself. We've done enough deals that we know the markets. We know the markets themselves, and we really have the experience. And we number one thing for us is our client and making sure the client's happy. So
amazing. Yeah, what a tremendous asset to have you guys on the team and to be able to leverage that network. Just for all things commercial real estate deals even outside of actually getting your deal financed. So
yep.
As we wrap it up, I just want to thank you so much. What is the best way, if anyone's listening right now, you guys want to call Chaim, you want to get on the phone with him, you want to shoot him your deal, what's the best way for people to get a hold of you? We'll drop that right here on below so they can contact you.
Awesome. Thank you, Ben. I appreciate it.
Yeah.
Great, really great chatting again. And again, real estate's an awesome investment. It's tough sometimes, when you're starting off by yourself and you don't know what you're doing. But when you have a team, I know Ben, he's great, top of the line stuff. He's got a great team. I've worked with him on numerous different occasions, and it's really great to to learn the business from. And I had it when I was starting off. I had a great team that I learned from, and it really assists in your future future deal flow and future I guess success, let's call it, of your investments. And again, everyone can do real estate. It's great to great to learn it, but when you learn it from a great team, that's really the best way to go. And we're always happy and there to help when needed.
All right. Well, hey, thanks so much. I really do appreciate you taking the time to join us here today and break down about a little bit behind the scenes, pull the veil back on what it's like working, what we're doing as we're getting these deals prepared to take out to our investment partners. So thanks so much, Chaim, and we'll talk to you next time.